Hey, what's up everyone? My name is Patrick. Hope you guys have an awesome day. In my last video, I talked about the importance of investing, covering the impact of inflation, how a savings account can yield lower returns than investing into the market, and how index funds work. If you haven't seen that video, please go check it out. Just as a disclaimer, I'm not a financial advisor. These are just my personal opinions, which I hope to share and hopefully can help educate people in a way I wish I could have learned. Maybe avoiding some mistakes I made along the way and helping people achieve their financial freedom dreams. In today's video, I wanted to start by covering how to create a plan and timeline suitable for you, and then sticking to it. It really is that simple to starting your investing journey, and why I wanted to make these videos to hopefully shed light on how accessible investing really is, as these are all things I've learned myself over the past couple of years. It comes down to a few things: your knowledge of what you're investing in, current versus delayed gratification, your timeline, and your risk tolerance. I know for me personally, saving without an end goal is pretty hard, as you don't really feel motivated to put that money aside. So the first thing I did was establish a goal. Why would you want to invest your money? Is it so that you can preserve your wealth? Would you like it to grow? Maybe you want to be a millionaire one day. Or maybe you want to purchase a house in the future. Whatever your goal may be, setting one will help you gain clarity not only what you want from your investment, but also from life. This is, as you could say, the first go green light in investing. With a goal, we can now work on a timeline. Obviously, everyone has different situation and for when they would like to see results. For some people, it's in 10 years. For others, it's about retirement. Having a general idea of your time horizon will help you make more informed decisions. Typically, when you're in your 20s, you have very little commitment and have just started earning, which also happens to be one of the best times to start investing. Your future self will thank your current self, as the earlier you start investing, the more time you have on your side to let your money grow. A timeline will also help you keep focus and guide you through any turbulent times in the market. One thing to remember when investing is time is almost always on your side, so it's never too late to start, and the historic results are there to prove it. The next part is finding your risk tolerance. Some people are more risk adverse than others in their 20s and choose more speculative assets. When people hit 30 or 40, they might shift some of their assets from higher risk to lower risk ones. And this is very similar how pensions funds operate. Shifting money towards lower risk assets and more stable assets the closer the person is to retirement. There is no right or wrong way, you just have to find a way that you are comfortable with. Research the topics and decide which is best for you. I will share in future videos how I allocate a percentage of my portfolio into each class. With a goal and timeline in mind, you can now find out how it is best to achieve that goal based on your risk tolerance. One of the lowest forms of risk, and one of the assets I'll be talking about today, is a fixed interest savings account. It is important to have cash on hand for everyday usage and taking advantage of any downtimes in the market. As we discussed in previous videos, these are rarely better than the inflation rate, so you essentially are losing money. The next step up in risk might be investing into bonds or gold. These can offer slightly better returns than that of a savings account and are usually in line with inflation. Therefore, you're preserving your wealth, but not really building it. The next step up in risk is funds, which I think is probably one of the best ways to start getting investing and getting exposure to the market, as they offer a good rate of return in comparison to the risk, exposing you to a lot of different companies in all the major sectors. As you go down the scale and approach the more riskier side, picking individual stocks can be very beneficial with greater returns on your investment, but also posing a lot more risk than a fund. This is because in a fund, if a company does poorly or fails, the rest of the companies can absorb the loss of that company and you can still end up positive, as you only owned a fraction of each of these companies. When picking an individual stock that does poorly, sometimes you can actually lose the majority, if not all, of your investment. So it really is up to you and how you stomach your risk. Because on the flip side, picking a good company such as Apple or Tesla this year alone would have yielded far greater results than the stock market returns. In a future video, I'll talk more about diversification versus concentration. But if you have conviction in a company and the management, vision, balance sheet all look good to you, then there can be a lot to gain from picking individual companies. Finally, we move to the most risky speculative assets. These might be unestablished cryptocurrencies or tiny companies without a proven track record, but potentially a bright future. If they do succeed, and very few do, your potential return can be astronomical. However, as a majority fail, people usually only allocate a small percentage of these in their investment portfolio. When approaching the riskier side of the scale, sometimes it is best to only invest money you can afford or have accepted as lost. This is due to the low success of these becoming a big hit. There is no secret formula or rule saying how you have to allocate your money into each asset class. Most people find a happy medium dipping their toe in all of these. For others, it may be just one or two of these. You might have noticed how I've left out real estate, land, and a bunch of other investments, as these are not usually as easily accessible due to larger sums of money required to get started in these. All the asset classes I mentioned today can be done easily from your computer, even your phone, so now it really is the best time to start getting excited and start investing. Please like and subscribe if you've enjoyed the video and learned something from it, and if you have any questions, drop them in the comments below and I'll happily answer them. Thank you guys for watching and see you in the next one.